Fixed costs are often interpreted as a signal of business strength. In reality, they are a measure of how much pressure your business can survive. The more rigid your cost base becomes, the more your stability depends on consistency. And consistency is the one variable most businesses do not fully control. Growth increases revenue, but it also increases commitments. And over time, those commitments begin to define whether the business is actually stable or simply dependent on momentum. Most companies follow a predictable pattern as they grow. Revenue increases, confidence increases, commitments increase. At early stages, businesses are naturally flexible. Teams are smaller, costs are lower, decisions are faster. The organization can adapt quickly because there are fewer constraints. But as growth begins to accelerate, a shift occurs. Founders begin converting variable costs into fixed ones. They hire permanent employees instead of contractors. They sign longer-term agreements with vendors. They invest in infrastructure that carries ongoing cost. They expand operations based on current performance. These decisions are rarely viewed as risks. They are framed as progress. More people signals growth. More infrastructure signals scale. More commitments signal confidence. And during periods of consistent revenue, these decisions appear justified. Cash flow supports the structure. Operations feel more established. The business appears more stable. From the outside, it looks like the company is strengthening, but internally, something more subtle is happening. The cost base is becoming less flexible. The organization is slowly shifting from adaptive to committed. And that shift introduces a different type of pressure. Over time, certain signals begin to appear. Cash flow becomes tighter, even with higher revenue. Margins begin to compress, not because revenue is falling, but because costs are fixed. Leadership becomes more cautious in decision-making. Hiring decisions take longer. Investments are evaluated more conservatively. Operational flexibility begins to decline. What once felt like a dynamic system begins to feel constrained. The business requires more output just to maintain stability. This is where the misunderstanding begins. Most companies believe they are building stability. In reality, they are increasing dependency. The issue is not fixed costs themselves. The issue is how they interact with revenue behavior. Fixed costs are forward commitments. They are decisions made in the present, based on expectations about the future. They assume that revenue will remain consistent. They assume that demand will hold. They assume that volatility will remain manageable. But most businesses do not operate in stable environments. Revenue is inherently variable. Customer demand fluctuates. Sales cycles shift. Clients delay payments. Markets evolve. Even high-performing businesses experience variability. When a business builds a rigid cost structure on top of variable revenue, a structural mismatch is created. This mismatch is not immediately visible. During growth, revenue can absorb the pressure, but the system becomes increasingly dependent on maintaining that level of performance. The business is no longer operating with margin. It is operating at a required baseline. This changes how the organization behaves. Leadership decisions begin to shift. Instead of asking, "What is the best strategic move?" the question becomes, "What ensures we can sustain our commitments?" Cash flow becomes something to protect, not something to deploy. Risk tolerance decreases. Optionality is reduced. The organization becomes more sensitive to disruption. Even small fluctuations in revenue can create disproportionate pressure. This is the structural reality of fixed costs. They do not create stability. They test whether stability already exists. If the business cannot absorb variability without disruption, the issue is not external. It is structural. To understand this dynamic more clearly, it is useful to evaluate cost structure through three strategic lenses. 1. Revenue variability versus cost rigidity. Revenue is inherently variable. It changes based on timing, customer behavior, market conditions, and execution. Even strong businesses experience fluctuations. Fixed costs, however, are constant. They do not adjust when revenue slows. They do not respond to changes in demand. They remain in place regardless of performance. The relationship between these two forces defines pressure inside the system. If revenue variability is high and cost rigidity is also high, pressure increases. If revenue variability is moderate and cost rigidity is low, the system remains stable. The key is alignment. Stability is not determined by revenue size. It is determined by how well revenue behavior aligns with cost structure. When that alignment breaks, pressure builds. 2. Commitment load determines breakpoint. Every fixed cost represents a commitment. Salaries, contracts, infrastructure, recurring obligations. Individually, these commitments may seem manageable, but collectively, they define the baseline performance required to sustain the business. This baseline is not optional. It must be met every month. As commitment load increases, the margin for error decreases. A business with low fixed costs can absorb fluctuations. A business with high fixed costs cannot. The breakpoint moves closer. A small disruption in revenue can trigger significant pressure. Cash flow becomes tight. Decisions become constrained. Operations become reactive. Commitment load defines how much pressure the business can tolerate before instability occurs. 3. Flexibility preserves strategic control. Flexibility is often misunderstood. It is not inefficiency. It is capacity. Variable cost structures provide room to adjust. They allow the business to scale costs up or down based on performance. They create space for decision-making without immediate financial pressure. Flexibility allows the organization to absorb shocks without disruption. It allows leadership to act based on strategy, not constraint. Without flexibility, the organization becomes rigid. Decisions become limited by existing commitments. Opportunities are evaluated through the lens of risk. The business becomes slower to respond. Flexibility is what preserves control. Without it, growth becomes restrictive. For founders and executives, the implication is structural. Growth should not be evaluated purely by expansion. It should be evaluated by how cost structures evolve alongside it. Every increase in fixed cost raises the baseline performance required to sustain the business. This creates dependency. If revenue remains consistent, the system appears stable. If variability increases, pressure accumulates quickly. Over time, this changes how the business operates. Leadership becomes more defensive. Decisions become slower. Opportunities are filtered through risk rather than leverage. The organization becomes reactive. This is where many companies lose strategic advantage, not because they fail to grow, but because growth introduces constraints they did not anticipate. In contrast, companies that manage cost structure intentionally operate differently. They do not eliminate fixed costs. They align them with realistic revenue behavior. They preserve flexibility even as they scale. They build systems that absorb volatility instead of being disrupted by it. This creates a different type of organization, one that can operate under pressure without losing control, one that can act decisively when opportunities emerge, one that is not dependent on perfect conditions to perform. The advantage is not just financial, it is strategic. These companies maintain optionality. They can invest when others hesitate. They can adjust when others are constrained. They are not limited by their own structure. A business is not defined by how much revenue it generates. It is defined by how much pressure its structure can absorb without losing control. And fixed costs are where that pressure becomes visible first.